All right, let's just jump right in. If you're running a business, you know accounting can feel, well, like a chore, right? It's this world of complicated numbers and rules you'd probably rather just ignore. But what if I told you that all those numbers are actually telling a story? In this explainer, we're going to break down accounting and show you how to read the financial story your business is telling you, day in and day out.
First things first, we got to reframe how we think about this whole thing. Accounting, it isn't just for taxes. It's not just about staying out of trouble. It is literally the language your business uses to tell you how it's doing, where it's strong, where it's struggling, and where the big opportunities are. You should think of it as your most powerful storytelling tool.
Look, let's be real. You didn't start your company because you had a deep, burning passion for bookkeeping. Am I right? Your head was filled with the mission, the awesome product you were building, the service you were offering, the impact you wanted to make. The numbers were just something you had to deal with.
But here's where we flip the script. What if those numbers weren't just a headache, but were actually the key to unlocking major insights? What if they could tell you this incredible story about where you've been, where you are right this second, and where you're going? Well, that's exactly what we're going to dig into. So, how do we actually read this story? Well, the plot really unfolds across three main documents. I want you to think of them as three giant windows that let you look deep inside your company's financial soul: the balance sheet, the income statement, and the statement of cash flows. Let's start with that first window, the balance sheet. At first glance, it might just look like a boring list of stuff. But this document, it's all about the fundamental structure, the very foundation of your entire business.
The word I really want you to focus on here is snapshot. Unlike the other reports, the balance sheet is like a photograph. It captures your company's financial position on one single day, like midnight on December 31st. It shows everything you own and everything you owe at that precise moment in time. And this is the golden rule, the one equation that holds the whole thing together. It has to balance, always. On one side, you've got your assets. That's all the stuff the company owns, like cash, inventory, buildings. And on the other side, you have the claims against that stuff, your liabilities, which is what you owe to banks and suppliers, and your equity, which is what's left over for the owners. Those two sides must be equal. It's non-negotiable.
Okay, on to our second window, the income statement. You've probably heard this called the profit and loss statement, or just P&L. If the balance sheet was about structure, this one is all about performance. So here's the big difference. If the balance sheet is a photo, a single snapshot, the income statement is a movie. It tells the financial story over a period of time, like a month or a quarter or a whole year. It takes all your revenue, subtracts all your costs, and gets you to the famous bottom line, your net profit or loss.
And now for our third and final window. And honestly, this one might just be the most important of them all, the statement of cash flows. This one strips away all the accounting jargon and focuses on the one thing that truly matters: cold, hard cash. And here's why this is so critical. A company can be profitable on its income statement and still go bankrupt because it has no cash. It happens all the time. This statement cuts through that noise and gives you the real story of where your cash came from and where it went, breaking it down into three simple categories: cash from your day-to-day business, cash from big investments, and cash from things like loans. Now, you might be thinking these are three totally separate reports, but that's not quite right. The real aha moment comes when you see how they're all connected, weaving together to tell one single coherent story. Seriously, remember this. Looking at just one of these is like reading a single chapter of a book and then trying to guess the ending. You just can't do it. You need all three to really understand what's going on. So, for example, the net income, that bottom line from your income statement, doesn't just vanish into thin air. It actually flows over to the balance sheet and increases the equity. And the final cash balance on your statement of cash flows, it has to perfectly match the cash number listed as an asset on your balance sheet. See, they're all talking to each other, constantly checking and balancing one another. Okay, so for this whole story to make sense to everybody, investors, banks, there have to be some rules of the road, right? Let's quickly touch on the basic principles that keep everything consistent and trustworthy. This is basically the heartbeat of all accounting. It's called the accounting cycle. It sounds fancy, but it's just a simple rinse and repeat process that turns every sale you make or bill you pay into those three big financial statements we just talked about. You see it, you write it down, you organize it, and then you summarize it. That's the whole game. Now, one of the biggest rules you'll bump into is this choice between cash and accrual accounting. And the only real difference is timing. Cash accounting is super simple. You record money when it comes in or goes out. That's it.
But accrual accounting, which is what most businesses use, records revenue when you earn it and expenses when you incur them, even if no cash has actually changed hands yet. And why is this accrual thing so important? Because it gives a much truer picture of your company's performance over time. It's so vital, in fact, that it's the standard. Get this. About 98% of public companies use an indirect method for their cash flow statement that starts with their accrual-based income. It's the industry standard for a very good reason. And finally, to make sure everyone's playing by the same rules, there are basically two main rule books used around the world. Here in the US, companies follow GAAP, generally accepted accounting principles. It's very detailed, very rules-based. Most of the rest of the world uses IFRS, which is a bit more principles-based. As a US business owner, though, GAAP is going to be your guide. Okay, we know how to read the story, we know the basic rules. Now we get to the most important part of all. How do we use all this info to actually make smarter, better decisions for our business? This is where financial ratios come in, and they are awesome. Think of them like quick little cheat codes. They're simple calculations that take numbers from your statements and give you instant answers to huge questions. Questions like, can we pay our bills? Are we actually making any money? And how much do we rely on debt? For pretty much any business owner, this is the question that can keep you up at night, right? It's all about liquidity. Do you have enough cash coming in or assets you can turn into cash quickly to cover all your immediate bills? And here's a fantastic, super easy tool to answer that. It's called the current ratio. You just take your current assets from the balance sheet and divide them by your current liabilities. As a general rule of thumb, if your ratio is 1.5 or higher, you're probably in a pretty healthy spot. But if it dips below 1, that could be a warning sign that you might struggle to pay your short-term bills. It's a powerful little health check you can do in seconds. So there you have it. The statements, the rules, the tools. You now have the basic framework to read your business's financial story. So the only question left is, now that you have this understanding, what are you going to write in the next chapter?